Good morning and welcome to Keypoint's webinar on tax disputes and transfer pricing. I'm Ramanori and I head the tax and transfer pricing practice at Keypoint and also have the pleasure to be a host for this morning's webinar. By way of a brief background, I'm a UK chartered tax advisor who has worked with leading professional firms, including the Big Four, both in the GCC and in the UK. I have significant direct and indirect tax experience, and I've also worked on a number of transfer pricing engagements. Joining me this morning is my colleague Dinesh Ravi, a manager in our tax team. Dinesh is a specialist at tax and zakat compliance and advisory services for the past 8 years, having worked also in a Big Four. He has extensive tax treaty experience, having worked on a number of double tax treaty exemptions and other due diligence projects. Good morning, Dinesh.
Good morning, Raman, and good morning all. My pleasure to be here with you all today.
We also have my colleague Adil Fauzi, who will be joining us as an analyst. Adil has over 10 years of experience in a number of different roles, including auditing and tax and zakat. He too has a Big Four background and also worked in the industry before. Adil, good morning.
Thanks, Raman. Good morning. It's a pleasure to be joining.
Excellent. We are a growing practice in Saudi Arabia and are acutely aware of the importance of working with subject matter specialists. I'm delighted to be joined today by one of these special guests, Shiv Mahalingham. Shiv is a tax partner at the Kragus Group, a leading Tier 1 consulting firm which has a presence across the GCC. Shiv has over 25 years of international tax experience and was previously the regional head of transfer pricing at a leading professional services firm. Good morning, Shiv, and it is a great pleasure to have you with us today.
Good morning, Raman. Good morning, everyone. Yes, it's an honor to be able to speak today. Thank you.
Excellent. Great. Well, I'm aware that many of you are extremely busy with the year-end internal audits and so on, and have given up their valuable time. So let's get started. This morning, we will be giving you an overview of the tax appeal system. Many of you would be aware that the appeal system was radically overhauled back in 2019, and in January this year, the appeal committees were set up. There are a number of various levels in the appeal system procedures, and I'm sure that many of you are unsure about exactly what steps that need to be taken in order to traverse through all these procedures. The next thing we will be talking about is an update on transfer pricing. It's now been 3 years from the introduction of the requirements, and a lot has happened. Affidavits are very much the norm and part and parcel of the annual tax compliance cycle. The Saudi Tax Authority, the Gazette, is increasingly questioning, requesting for documents. TP audits have been issued lately, and they're looking to challenge multinational entities, MNEs operating in Saudi Arabia, to justify both their commercial existence and the pricing methodology they adopt in intergroup transactions. Shiv will share some of his experience in assisting clients with TP rulings and audits. And finally, we'll just quickly highlight some of the key points in the double tax treaty, which was signed between Saudi Arabia and the UAE in January this year, first of its kind between any two GCC countries. As you've guessed, today's webinar is primarily aimed towards businesses in Saudi Arabia. If you're a regular subscriber to our monthly series of tax webinars, that is Tax Matters, you will be aware that in those webinars, we provide our view on latest tax and VAT updates. We want today's webinar to be as interactive as possible, so please feel free to ask any questions using the Q&A function, which should be at the bottom of your screen. We aim to wrap up within 1 hour, and that will include some time for questions at the end. Okay, so tax assessments. If I guess anyone working in finance or tax in Saudi Arabia will know that the Gazette has become noticeably more active. We're seeing more visits to establishments, inspections, requests for documentation, and more analysis of financial statements, more queries, and obviously eventually more assessments. So I guess it's a good time to summarize the entire appeal process, which is largely the same for all taxes. And what I mean by that is whether you're a taxpayer, zakat payer, or VAT payer, the appeal system procedures are pretty much the same. So here we have, typically there are 5 parties to an assessment. We have the Gazette, the Saudi Tax Authority. We have the Saudi taxpayer, which, as I said, could also be a VAT payer or a zakat payer. We then have the GSTC, that's the General Secretariat of Tax Committees. Now, this is an administrative body that basically collates all the case documents, which is then heard at the appeal committee level. Typically, the file would contain the original assessment, the response from the taxpayer, and then the amended assessment, which is issued by the Gazette upon review of the taxpayer's response. Now, and then there is the ISE, which is the Internal Settlement Committee. Now, this body sits outside the appeal committees and is primarily tasked with being a mediator in order to agree a settlement between the taxpayer and the Gazette. And finally, you have the appeal committees. So there are 2 levels. The first one is the TVDRC, that's the Tax Violation Dispute Resolution Committee. And then you have the upper level, which is the Tax Violation Dispute Appellate Committee. Okay, so let's start by say that the Gazette has issued an assessment. Now, be mindful that at any point of time during this entire procedure, the taxpayer can always accept and settle the due liability and the case would be closed. But let's just say that the Gazette has issued an assessment, the taxpayer wants to file an objection, he has 60 days to do so. Now, the rules are slightly different for zakat and VAT, which we will come on to shortly. But one thing to remember is at the time of filing an objection, you must settle the tax on any accepted points. If you do not, then technically your appeal against the amounts you dispute may be rejected by the Gazette. The Gazette then has 90 days to respond to the objection. Typically, they would review the documentation and the objection letter and issue an amended assessment, which obviously the Gazette, which obviously the taxpayer may want to appeal further, or they may not receive, or the taxpayer may not receive a response within 90 days. In either scenario, the taxpayer then has the option to escalate the case to the appeal committee via the GSTC body within 30 days of either the 90-day period or the date the amended assessment was issued. During this entire process, that is from the time the amended assessment was issued up until the case is set for hearing at the appeal committee, the taxpayer can always approach his Gazette relationship manager and have a meeting with the ISE with a view to agree a settlement. As I'm sure you're aware, litigation, just like anywhere else in the world, is costly and time consuming, so may be an option for the taxpayer. Assuming that the taxpayer doesn't go to the ISE, then the only option available is to proceed with the appeal committee hearing. So you've got, as I said, 2 levels. The first one is the resolution committee. Now, these committees were set up in January this year and are based in Riyadh. However, at the minute, the hearings are not taking place in person because of the ongoing COVID situation. So all the hearings are online. And typically you have a panel of 3 judges that have an accounting and tax background that oversee the hearing. Before the hearing is convened, the taxpayer is required to provide a power of attorney, appointing either someone from the organization or a consultant or a lawyer or both to represent them at the hearing. Once the decision of the resolution committee is known, the taxpayer, if he wishes to appeal, has a further 30 days to take it up to the tax violation and dispute appellate committee. Now, one thing to note is before you escalate the case to the appellate committee, you are now required to submit a bank guarantee for the full disputed amount. Again, if you do not do that, then the hearing will not be convened. I think the process for the appellate committee is pretty much the same. They would oversee the decision taken by the resolution committee, and the case file will be presented. And based on the documents provided, they would then issue a decision. The decision itself is final. So if it goes against the taxpayer, then he is required to settle the liability and cannot take it further forward. So this is basically quite a snapshot or a brief summary of the various steps and procedures that a taxpayer needs to go through if he wants his appeal heard in front of the appellate committee.
Raman, on behalf of the participant, I would like to ask one question. Are ISC decisions legally binding on either the taxpayer or the Gazette?
Good question, Dinesh. Actually, no. The ISC decisions are not binding on either party, so neither the Gazette nor the taxpayer. The ISC is simply a way of closing assessments before formal legal proceedings begin.
Thanks, Raman. This seems like fairly complicated appeal system. What are the common issues faced by the taxpayer while navigating this entire process?
In my experience, one of the hardest things that I've seen is the authentication of the power of attorney. There are several attestations required, both outside and inside of Saudi Arabia. And also there is a prescribed template issued by the Ministry of Justice. I've seen a number of appeals being rejected simply on procedural grounds because the power of attorney has not been properly authenticated or attested. Taxpayers would be well advised to obtain legal advice or to speak to the Ministry of Justice in this matter. And another thing to remember is that these appeal committees are effectively courts of law. So in addition to your tax consultant, you may also have to appoint a law firm to develop and present a legal argument. It really all depends, I guess, on the complexity of your case. Okay, now that we've looked at the assessment and appeal process, I'm going to hand over to Dinesh to go through the settlement procedures.
Thanks, Raman. Thank you for that useful overview. As Raman explained about the different parties involved in the entire assessment cycle, as everybody knows, like what are the parties involved in the assessment cycle. So as important, like knowing the assessment parties and the timeline to submit the response, it is important to know what are the other settlement obligation that the taxpayer as a zakat payer need to comply as per the regulation. So let's start with the important clarification. Raman mentioned that taxpayer only have to settle the tax liability on the accepted points when filing an appeal. But the situation is slightly different for zakat and VAT cases. In case of zakat payer, you are required to settle 10% to 25% of your disputed amount, or submit a bank guarantee for at least 50% of the fully assessed amount. That is like the 50% of the objected amounts. This provision was introduced in the new zakat regulation that came out in 2019. In case of VAT, you're required to settle 100% of the objected amount or submit a bank guarantee of the full objected amount, including the penalties at the time of appeal. As I said, like this is important to know like how much percentage or how much amount you need to settle during the appeal process, because where in case like if you file your objection with all your technical argument to the tax authority, but fails to comply with any of the settlement procedure, that the objection is not valid and there is a possibility that Gazette would reject your application on the basis like the settlement has not been made on the initial objection. Having said that, we have successfully advised number of VAT clients on appeals and persuaded Gazette to cancel the penalties under the current amnesty scheme so that the payment or the bank guarantee is made only for the principal amount and the penalties will be cancelled.
Dinesh, I have a question from the audience. In your experience, how successful are these appeals? Do the committees often change the Gazette assessments or rule in the taxpayer's favor?
It's an interesting question, Roman. We have worked with a number of clients in the assessment and appeal process. Some clients have accepted an assessment and settled the liability. Some clients have approached the internal settlement committee, and some have lodged their appeal process with the GSTC. That means for the further appeal committee's hearing. What we have seen is that GSTC is particularly working very well. Means like client can able to negotiate and have a good settlement up to 50% from the original liability. The tax amnesty scheme also is successful, where client can able to accept the assessment with the associated penalties being waived till 31st of December. So that's another good way for the taxpayer to consider their tax assessment position. And in terms of hearing, we have not come across many hearing taken place, as you all know, because of the current COVID situation. And also the few hearings that has taken place seems like taxpayer have not had many decisions ruled in their favor.
Great. Thank you, Dinesh. Excellent. So we now move on to transfer pricing, and I shall hand over to Shiv, who will give us an overview of the regime in Saudi Arabia.
Thank you, Rahman. No, I appreciate that. It's good to go through the dispute resolution process because a lot of that will be directly relevant to transfer pricing also. It's, as you quite rightly pointed out, we've had transfer pricing in Saudi for coming up to 2 to 3 years now. I'm going to start by just going through a refresher of the regulations themselves, and then we'll talk a little bit about our experience on the ground, what we're seeing in terms of challenges from Gazette, etc. So the regulations apply to all taxpayers that are subject to the income tax law. Zakat entities continue to be exempt from most of the documentation requirements. They still have a requirement for country-by-country reporting, as many of you will be aware. And so really you can summarize the regulations as a 4-tier approach. So we have the country-by-country report, which is at the group level for multinational groups. And that is relevant to any consolidated turnover group exceeding $850 million. Now that's completely aligned with the OECD number as well. So you can see that there's a good deal of consistency already with the OECD guidance in KSA. That country-by-country report needs to be filed every year. So KSA parented groups would need to file that with Gazette. Any multinationals parented outside of KSA have a notification requirement, of course, which is now part of the tax return disclosure form. The master file, the second tier, is at the group level also. So you wouldn't need to do anything separate in Saudi with respect to your group master file. And that needs to be prepared for taxable persons that have intragroup transactions exceeding 6 million Saudi riyals. As I mentioned, that master file is something you should have in place already. And the recommendation at the OECD and at the Saudi level is that it only needs to be updated every 3 years, unless there are material changes in place within the group. The third tier is the local file. Now that is at the entity level within Saudi. So this is where a lot of the work would need to be done to support your transfer pricing every year. And this again is for every taxable person that has intragroup transactions exceeding 6 million SARS. The local file can be refreshed every year in terms of the economic analysis, but again, if there are no material changes, then that shouldn't be too onerous an exercise. And then the fourth tier is this affidavit, which is signed by advisors to attest that your transfer pricing policy has actually been adhered to. So this is an important point. I'll come on to this later on about consistency within documentation, intergroup agreements, financial systems, tax returns, and making sure the transfer prices are reflected throughout all of these different mediums. The affidavit needs to be filed with the disclosure form and the tax returns every year. And as Raman mentioned, we've now had a couple of years of going through this process. So later on, I'll talk through some of my experiences on the ground in terms of tax audits, transfer pricing audits, and how best to, well, number one, how to avoid them in the first place. And then also, once you have an audit, how we deal with that going forward. So moving on with the slides.
Shiv, just a quick question here.
Yeah, go ahead, Ron.
Yeah, you know, the TP guidance has been issued by Saudi Arabia. You mentioned about the OECD guidelines. Mm-hmm. Is it basically a blueprint of the recommendations, or are there any departures?
Yeah, that's a good question. There are a lot of positive elements, a lot of consistency between the OECD guidance and the KSA guidance. I think the most material departures, one is the effective control test, is more wide-reaching within Saudi. So there are tests for control by business, governance, and finance, which are beyond the more traditional share participation control relationship. The other changes I'll come on to a little bit later on in terms of preference for local comparables, etc. But and the affidavit, of course, is quite a big distinction that we see within Saudi as well, and something like that doesn't exist in many parts of the world. But for the main, Raman, there's a good deal of consistency between the guidance, and in fact, the KSA transfer pricing guidance even defers to the OECD guidance on matters in which it falls. So if there's anything that's not mentioned within the KSA guidance, then the recommendation is to then go to the OECD guidance to see if you can seek clarification within that set of regs.
Great, that's good.
Okay, we can move on to the next slide. Thank you. So the most recent set of transfer pricing guidance came out a couple of months ago. The Gazette released some additional elements, and one of the most important things I've set out here was a step plan for multinational entities with respect to how they should approach transfer pricing every year. So you can see here I've set it out: subject, analyze, test, document, and implement. And let's run through each of those, because I think it's important for businesses to be aware that this is an ongoing process throughout the year. So the subject identifies which entities and transactions are within scope. It's not as obvious as it sounds. As I mentioned, careful attention should be paid to the effective control tests. And also the guidance did confirm the importance of looking at economic ownership. It's not just legal contracts, but also the economic elements and the underlying substance behind transactions. And of course, mixed entities as well. I mentioned Zakat entities are exempt from a lot of the regulations, but mixed entities will be included. So that's an important point, especially when you start to roll forward your documentation year on year. It's important to stop and say, actually, let's just make sure we are covering all the entities and all the transactions that we need to before we move on. Second is to identify and delineate the transactions. That really just means we drill into a lot more detail within the transactions themselves, and then try to understand what the appropriate transfer pricing methods would be. So analyze and then test the appropriate transfer pricing method. After you've managed those first three items, we move to documentation, and we look at support, robust evidence, evidentiary support that the transactions that we have are at arm's length. And then finally, the implementation piece. And I mentioned before the affidavit, how critical that is. And the guidance recommends, the KSA guidance recommends businesses review their arrangements throughout the year and adjust any systems, accounts, schedules, agreements that they need to during the year, rather than waiting until the end of the year. We've long called that real-time transfer pricing within the OECD framework. It can really be helpful for groups to start to think about that on at least a quarterly basis to make sure that there are no surprises at the end of the year. Roman, any questions about that, or should we move on?
Yeah, actually, I have one. One of the more common questions that clients ask me is with regards to the benchmarking study. Now, if you have local comparable data, is that something you could use as part of a benchmarking study?
Yes, absolutely. So I think the starting point is if the group has their own transfer pricing policy, their own approach to benchmarking. So consistency is always really important. So start with what the group has in place already, and then we can look to localize it. So quite often you just need to demonstrate that you have looked for local comparables. If you haven't found any, you may find some, you may not. But at least demonstrating that you've gone through that process is very important. And then once you've exhausted that, then moving to the core transfer pricing policy of the group and applying that within KSA is a good approach. You don't have to reinvent the wheel. And certainly my interactions with GAZA support that as well, that they are happy to look at regional comparables, even global comparables where they are relevant to the business and to the transactions that they're looking at. So this is a concern, Raman, yes, a lot of companies have, but I think as long as you've demonstrated that you've looked at those local nuances, such as the effective control test, and looked for local comparables, then you can then go back to the default transfer pricing policy of the group.
Excellent.
Okay, we can move on. The specific guidance I referred to that came out a few months ago, there are specific elements around business restructurings, intangibles, financial transactions, and valuation approaches. Now, this really does mirror the OECD guidance quite closely. So business restructurings would be any M&A activity, business expansions, carve-outs that you have within the group itself. Now, in the affidavit, I'll come on to this later on, there's a little box where you tick whether there have been business restructurings within the year or not. So that's obviously something of key interest to GAZA. The intangibles, so this is really all the intellectual property that the business has. Could be brands, marketing intangibles, could be production intangibles, etc., from having developed any kind of intangible intellectual property itself. Financial transactions, loans, guarantees that are in place, and then valuation approaches. So if we have a value for businesses and transactions, the recommendations there to have consistency with traditional valuation approaches, which may be for IFRS purposes. And then for transfer pricing, we have other different guidance that would need to be respected. We will forward a summary of this. I put this together in an article that we can forward if anyone's interested in more of the detail around this. We'll be happy to pass it on. Roman, did you have any questions about these items? Or?
No, that's fine.
Okay, so that's a kind of summary of where we are in terms of the regulations. Now let's talk a little bit about its frontline experience and what we've been seeing. So around, well, more than 2,500 affidavits are filed every year with the disclosure forms, which is a significant number, of course. So the tax authorities, GAZA, adopt what we call a risk-based approach. So they'll be looking for high-risk areas, and those will be the items that will be selected for potential transfer pricing audits going forward. The domestic transactions do need to be included. Now, that some parts of the GCC in the Middle East, tax neutrality, if you can demonstrate that your transactions are tax neutral, and what I mean by that is if you have a deduction in one entity and a receipt in another entity and they're at the same level of rate of taxation, then that will be a tax neutral transaction. So some parts of, as I mentioned, the region, if you have tax neutrality, then transfer pricing is not an issue. However, GAZA, within the KSA framework, we do have to look at domestic transactions. So they need to be included in affidavits, in documentation, etc. But they should be low risk in terms of being challenged if you can demonstrate that neutrality. And they may not be neutral. You may have different tax rates in those transactions. I'll put this here again. The TP policy implementation is critical. We've discussed the importance of that with the affidavit. And having consistency between your documentation, intragroup invoices, intragroup agreements, management accounts, returns, and the financial statements. If there's one area of this that doesn't report to another, then you'd be leaving yourself open to tax audits, challenges, and various questions. So important to have a consistent story across all of that documentation, not just the local files, but all of the different elements that you have set out here. And then the affidavits themselves, we really see three different categories. So the first is a proof in total, and this is really where you can say, I have a 3% return on sales policy, and I can calculate that 3% on sales has been charged, and therefore therefore it's proofed in total. And we're happy that we can sign that affidavit that the policy has been adhered to. The second is where we look at the material transactions. And we say, look, there's a lot of transactions within the group, but we've been able to prove 80% of these transactions. And within the language of the guidance, it does talk about materiality to a significant level. And the language supports this approach to say to businesses, we don't need you to attest to everything. But as long as you have the material significant items covered, then that's fine. So the second item, which you'll see a lot with affidavits, is proofing the material transactions and perhaps taking what we call a de minimis view of the smaller ones. And then the third one is where you have really a significant number of transactions. Maybe banks, high frequency traders, one of my clients is a company, and the intergroup transactions are too willingness to even think about proofing. And therefore you'd use a sample basis. And this is something that many of you that's encountered financial audits every year, you'd be familiar with this approach of taking things on a sample basis going forward. Okay, Raman, did you have any questions about the affidavits themselves?
Just one point. I just wanted to link the affidavits with the annual tax compliance cycle. Now, taxpayers would be aware. It doesn't apply to zakat payers, but taxpayers would be aware that at the time of filing their tax return in April, they're also required to file the transfer pricing affidavit. Now, that is signed off by a SOCPA licensed person, and in order to do so, it is in effect a limited or reasonable assurance engagement. So the SOCPA licensed auditor would be looking to make sure that the related party numbers are reconciling to the financial statements as well as to the primary books and records of the client, be it the general ledger or the trial balance. So it's just something to remember that the SOCPA license person would require some supporting documentation to verify the existence of the related party transactions and obviously the TP methodology before he signs off on the affidavits.
Yeah, thank you, Raman. That's very important. And the other thing with the affidavit that has just changed the dynamic a little bit is that a lot of groups over the years have taken the approach of saying, we will prepare transfer pricing documentation in our material locations. And then if we're challenged elsewhere, we'll then prepare documentation as part of a reactive process. However, if you're ticking the tax return every year as documentation is in place, you're really unable to take that approach. If you think that pricing documentation is in place, then it should be in place. This is quite a big change as well, that you have to attest to that every year. Okay, moving on to the audits and tax rulings. And the start of this presentation was very helpful in setting the scene for the tax audit process. And it's the same for transfer pricing. It falls within the corporate income tax.
Excuse me, Shiv, sorry, could you speak a little bit louder? It's just you're going in and out.
Yeah, sure, absolutely. So the tax audits for transfer pricing, they fall into two categories. You'll either have a field audit inquiry or a transfer pricing inquiry. And the difference between the two, the field audit is really looking at different areas of tax. And many of the businesses listening today may have already received such documentation correspondence in the past, but it's an audit inquiry that looks at different areas of tax law. On-site visits have been reduced at present, and there's an increase in correspondence-based field audit inquiries that we're seeing. Or a transfer pricing inquiry, which will focus on the transfer pricing elements. And those transfer pricing inquiries ask for 5 specific items. So they ask for the master file, the local file, the transfer pricing policy, comparability analysis, which will form part of the local file for most groups, and also intergroup agreements. And I've got a note here on the policy itself. Now, that could be local, regional, or even global. So really it's up to the group and their advisors to decide what transfer pricing policy that they send across to GAZA. But as long as it supports the local file transfer pricing, then that's something that would be fine. But Raman, did you have any questions on this one?
No, that's fine. Thank you.
Okay, good. We can move forward. Okay, and now I often get asked about what would cause a transfer pricing inquiry in the first place. So I'd say that over 75% of cases we've seen have been companies that are making losses or that have very low margins. And of course, this is critical in the current environment. So any losses that occurred in 2020 are going to need a lot of economic support in 2021 to ensure that you can demonstrate that that is not a function of transfer pricing, but a function of the economy. Business restructuring, I mentioned before, if that's ticked in the affidavit, you're likely to get questions on what format of restructuring it was and what the transfer pricing elements within. And also, I've seen some challenges where more complex transfer pricing methods have been applied, such as profit splits. I think a more straightforward cost plus transaction net margin or a comparable uncontrolled price, things that the tax authorities are more used to seeing. And if there's a healthy margin, there may not be a challenge, but something more complex may always trigger a question. Any material integral charge, so a large charge going across border may result in a transfer pricing inquiry, which is combined with a withholding tax challenge. And also, any suspicion of a permanent establishment that's not been registered, again, may start off as a transfer pricing inquiry and then move very quickly to a permanent establishment review. Those final two items, I think profitable groups who would not be as concerned about the top item there, the losses and low margins, they may still be challenged on the transfer pricing under those final two bullet points. So that's something important to bear in mind.
Shiv, just a quick question. We know the Gazette and dare I say, have taken a softer approach on tax audits because of the current economic situation. What is it the same on transfer pricing audits?
There's been a lot of activity over the past few months in terms of transfer pricing audits and challenges. I haven't noticed a slowdown in transfer pricing, Roma. So I'm happy to hear that that's been the case in direct tax. But certainly we're still seeing a lot of challenges from a transfer pricing perspective.
Okay, good, thank you.
Okay, and the final item I wanted to cover was around tax rulings themselves. So within the world of transfer pricing, you have advanced pricing agreement programs in many jurisdictions, and they can be unilateral or multilateral. Now, we don't have an APA program in Saudi as of yet, but what we do have are the Form R1001E tax rulings. And so this can be applied to get a unilateral transfer pricing agreement with Gazette. So it's available for any subjective and complex areas. If you're already under audit, it may be something to think about. And as I mentioned, it's unilateral, so it would be an agreement with Gazette. It's non-binding. A lot of companies over the years have asked me what the point would be in a non-binding ruling. Now, one thing I can say from experience is that if you have an agreement with the tax inspector, with your CRM, with your tax authorities, even if it is non-binding, you're unlikely to be audited on that, but at those areas that it covered. I've never seen a situation where an informal agreement or a non-binding agreement has been overturned. So it is a good level of certainty, and it'll be helpful for financial purposes as well. I put here it takes 1 to 3 months. Gazette's committed to responding within 45 days, as long as everything is submitted and it's submitted through the correct channels and all the necessary information is there. So you should be able to get something in place fairly quickly. And there are a number of transfer pricing rulings at the application stage. This is an early kind of area for those transfer pricing rulings. But as more and more rulings are filed, we'll have a better idea of certainty going forward. And the other point to bear in mind is that even a transfer pricing ruling could include a consideration of other tax areas, such as withholding tax. So it's certainly something to think about if clients are looking for certainty of their transfer pricing going forward. Okay, let me stop there. You guys have heard enough from me for a while. Roman, did you have any questions, or we may leave time for the end as well for any transfer pricing queries?
Just as maybe as your final thought, what do you think M&E businesses in Saudi Arabia how should they approach transfer pricing?
Yeah, absolutely. So I think the point I mentioned about an ongoing process, so within the year, quarterly reviews internally to make sure that there are no surprises at the end of the year. for a lot of companies, they're going to be going through this for the second or third time. So there's a lot of increasing knowledge and awareness within the business, which is really, really good. So that would help you manage risk going forward. And as I mentioned before, 75% of these cases we're seeing challenges are where there are losses and lean margins. So if that is your business, then really do think about how best to support that year 2020 and minimize the likelihood of a challenge going forward.
Excellent. Well, thank you very much, Shiv. That was very insightful. We now move on to the final part of our presentation on tax treaties. Dinesh, what's new in relation to the tax treaties?
Raman, the new updates came on 1st of January 2020. A double tax treaty between KSA and UAE came into force. Many organizations doing business in both the countries can take significant benefit from this treaty. We used to get a lot of queries from our clients like, what are the services that qualify for the treaty benefit under this double tax treaty between KSA and UAE, and what are the documentation is required, and all sort of questions that you will get answered in the next 5-10 minutes. We'll be covering up all these questions. So you can see our tables, like we have highlighted some list of services that can be benefited by using this DTT. The important thing to bear in mind before claiming a treaty benefit, the resident entity should make sure that non-resident entity is not establishing a PE in KSA. PE in the sense like it's permanent establishment. I mean the non-resident entity performing business in KSA for more than 183 days, then they establish a PE in KSA. In that case, the treaty benefit no longer be available for the KSA or UAE entity. So that is an important point that the business needs to keep in mind to make sure that PE is not being created in KSA for the non-resident entity.
Dinesh, what type of services typically would increase the likelihood that the non-resident creates a PE? So, in other words, would require him to be physically present in Saudi Arabia?
That's a very good question, Raman. So I would say the entity providing engineering or technical consultancy or support services in KSA would require their employee presence to work on certain services inside KSA. So in that case, there is more likely that the non-resident employee presence exists like more than 183 days would create a PE for the non-resident in KSA. And we have also seen like Gazette reject the applications of treaty where specifically in terms of like engineering or technical services business will happen in KSA.
Okay, another question. I mean, assuming the non-resident entity does establish a PE in Saudi Arabia, how is it taxed in Saudi Arabia? Can you give us a brief overview of what are the compliance obligations if it establishes a PE?
So what happens if a non-resident entity do their presence and conduct their business activities in KSA for more than 183 days? Then they have to register here with the tax authority and file their statutory obligation in terms of VAT, tax, or whatever the obligation that needs to be made. So that is where the treaty benefits also will get rejected, and the exposure is like non-resident would liable to register here and then pay the tax and withholding tax and VAT on their income that's been derived in KSA.
Okay, that's good to know. So I guess the takeaway here is that non-resident entities need to be very careful to ensure that they don't fall foul of the PE rule. We've seen the Gazette has in recent times been attacking this more vigorously, and a lot of treaty, at least the one that I've been involved with, we've seen that the Gazette has rejected the treaty exemption application on the basis that they perceive the non-resident entity as having established a PE. So really, it's something which is very important. Aside from the fact that the treaty benefit may not apply, you may find that your income generated in Saudi Arabia would then fall under the Saudi tax regime.
So we in the previous slide, we saw the different types of services that are eligible for double tax treaty. Here in KSA, we are going to talk about what are the process to get the treaty benefits. So in KSA, there is two types of treaty benefits. It's in the approach. Like first, it's a refund approach, and then it's an exemption approach. Refund approach is something like it's like a normal approach where you deduct the withholding tax and you submit your withholding tax return and remit the payment to the guesser. Then you file your refund application to the guesser to asking for the refund. The good thing about this refund approach, where the taxpayer will not get exposed to any financial penalties, where the tax has already been submitted to the guesser, and there will not be any exposure towards the delay penalties. And I will just highlight the documents that's required in order to submit the refund approach. One of the important documents that you need to get it from your non-resident, it's a tax residency certificate of the non-resident entity. And then the WTS return submitted with the guesser along with the payment proof that's been made to the tax authority. And then the refund application explaining the nature of services and which articles these services is covered. And then this application needs to be chambered and KSA, and that will be submitted to the guesser. Usually this refund, once the refund application is successful, after reviewing all the necessary agreement and the invoices, the guesser will issue the refund check in name of the resident entity. And in case of exemption approach, this is where the risk lies. As I told in my previous approach, refund approach, there is not much risk. In terms of exemption approach, you claim your treaty benefit at source. When I say you claim your treaty benefit at source, you will not deduct any withholding tax from your non-resident, and you pay your 100% of the invoice to the non-resident, and you claim your treaty at source by applying 0% or reduced rate of withholding on the specific service that qualifies for the treaty. So here the risk is like, in case after a certain number of years, Gazette found out that the service does not qualify for the treaty benefits, some possibility like the Gazette would reject the treaty application, and the delay penalties plus the principal 5% or 15% withholding liability would fall on the resident entity. So this is where business needs to be very careful to make sure that the service qualifies for the treaty benefit, and also, as we discussed previously, needs to make sure that the non-resident is not establishing a PE. It would also lead to highlight one of the key points in this double tax treaty between KS and UAE is that there is some article talks about the anti-avoidance provision, where the transaction or the business restructuring is mainly been happened to minimize the tax or tax evasion. Then there is a possibility that Gazette will straight away reject that treaty application. So that also needs to be considered. And in case of exemption approach, the documents that needs to be submitted along with your withholding tax return. So one of the documents is K7A, that is a prescribed treaty form issued by the Gazette, where you will disclose the name of the beneficiary, nature of service, and whatever the treaty rate, in case like if it's qualifies for 0 rated or if it's qualified for 10% reduced rate. So you'll mention that rate and you'll file along with your treaty. And then second would be K7B, that is a non-resident treaty form where the non-resident entity would need to get certified from their tax authority. In this case, it's Dubai. FTA needs to certify that all the income that has been derived here in KSA is being taxed in UAE. And then it has to undergo the Ministry of Foreign Affairs and Saudi Embassy attestation. So it's a quite bit of process, but you don't have to do this process for every transaction or every month. For example, when you take one transaction in 2019, in January, you obtain this K7B from your non-resident. For the following transaction in the same year and with the same nature of service, this K7B1 form will be sufficient to claim the treaty exemption approach. And then last documentation that required is K7C, that is undertaking form from the resident entity, where it says like in case of any false or incorrect information or arithmetic error or misrepresentation of the tax relief stated in the treaty, then the ultimate responsibility of paying the withholding tax and the delay penalty would fall on the resident entity. So as I mentioned earlier, this would be the undertaking that resident entity needs to carry the risk. The common challenges that we have noticed in claiming a treaty benefits on the payments made to non-resident, specifically in terms of like royalties, interest, where the beneficial owner condition met or not, that will be tested by the tax authority. When I say the beneficial owner, it's not clearly defined, but however, as per OECD model, the tax treaty commentary defines a beneficiary owner as a person who have a rights to use and enjoy the income without a legal or contractual obligation to pass on the income to the third party. So basically, the ultimate beneficiary should be the one who enjoys the income. So this condition needs to be met for claiming the reduced rate for royalties and interest. And, yeah, that's all the things needs to keep in mind while claiming a treaty benefit.
Okay, great. Thanks, Dinesh. So just to quickly summarize, so as I mentioned before, this is the first double tax treaty between any two GCC countries. So it gives businesses both in the UAE and in Saudi Arabia the opportunity to restructure the business in a way that they can legally reduce their overall tax burden. But having said that, there are specific anti-avoidance measures, which Dinesh pointed out, whereby if it is determined that the only reason why the restructure has happened was to avoid tax, then tax relief or credit may be denied. Okay, so we've now come to the end of our presentation. We've got about 7 to 8 minutes, and I will now open the floor for some questions.
We have one question from our participant, like Raman. Can we approach IAC even after registering the case with GSTC and escalating an appeal to DVDRC?
Yes, you can do. At any point, basically, once you've received an amended assessment, before the case is brought forward in front of the first level appeal committee, you can approach the IAC with a view to negotiate a settlement. What we've seen is this seems to have worked very well. The IAC seems to be pretty fair to both the Gazette as well as the taxpayer, and there's been instances where taxpayers have significantly reduced their overall tax liability by settling out of court.
That is another question. Is there any amount to be settled for tax and zakat companies before submission of appeal with Gazette? I will take this question, Raman. For a taxpayer, it's income taxpayer, the taxpayer is not required to pay any amount for the objected items. And of course, for the non-objected items, you settle the amount before filing an appeal. For the zakat payer, as we discussed in our initial presentation, zakat payer is required to settle 10% to 25% of the objected item, or to submit a bank guarantee of 50% on the objected item before filing your objection with Gazette.
Okay, Dinesh, we have a question here. We have a lot of vendors in the UAE for which we are deducting withholding tax. How can our vendors get advantage from the UAE treaty? Well, yeah. as you've already, right, I'll let you take this.
Yeah, as we discussed in our treaty benefit, like in KSA, we adopt two approach, like refund approach or exemption approach. As we discussed, the documentation required, your vendor is basically required to submit the list of treaty documentation prescribed as per the Gazette circular in order to claim a treaty. And one important documents, as I mentioned, like the tax residency certificate and tax treaty form, which needs to be attested by the tax authority in the non-resident country and the Ministry of Foreign Affairs. And also I would like to highlight another thing here. Before claiming a treaty, specifically in terms of service contract, you need to mention that you need to make sure that P is not established, as we discussed earlier. P is not established in KSA before claiming a treaty, because that would potentially reject your application. So please keep this in mind.
I have a question here. What happens if a taxpayer misses the specified time frame to escalate the case to the GST? Dinesh?
Yeah, if the taxpayer failed to escalate the case to GSTC within a specified timeline, then potentially a taxpayer would lose their rights to appeal against the further appeal committee, and the amount assessed in the assessment would be the final, and they need to settle the liability as per the assessment. So it needs to be very careful. Like, the taxpayer needs to be very aware of the timeline to escalate to the each parties involved in the appeal process. Along with this, they need to be make sure of the settlement percentage, how much needs to be settled before filing an appeal. That's an important point to remember.
Okay, another question specifically aimed at you, Dinesh. Mr. Dinesh says DTT is applied from Dubai. Why Dubai? Why not Abu Dhabi?
It's actually, probably I would have mentioned it. It's Dubai. It's for United Arab Emirates. So yeah. It's for Abu Dhabi, or it's for Sharjah. It's Dubai. It covers
all the 7 Emirati states.
Yeah.
Okay. Quick question, Dinesh. If any Indian IT entity transfers billing to KS entity from India to UAE entity, will they save withholding tax under the double tax treaty?
In this case, we have to see how the invoice structure and agreement is being framed. When your question is, if your question is aimed at claiming a treaty benefits, then as we discussed earlier, like, we have to see who is the ultimate beneficiary of this income, whether it's a Dubai entity or Indian entity who is passing on the cost. So depending upon the circumstances, then we can able to tell us like whether the qualifies for the treaty or not.
Excellent. Great. I think we've only got another couple of minutes, so I just wanted to basically say a couple of my final thoughts.
There is one more question, Raman.
All right, fine. Go ahead. Yes. Okay.
There's a question. What is the purpose of Internal Settlement Committee? Is it another court before DVDRC?
No, the Internal Settlement Committee sits outside the appeal system, the appeal committee hearings. So it's not a court of law. I think we've already mentioned before that the decision that's taken by the ISC is not binding on the Gazette or the taxpayer. It's just a means whereby the two parties are brought together across the table and negotiations are held with a view to agree a settlement. Obviously, it's up to the taxpayer whether or not they wish to accept or reject. If they wish to take it further, then it will proceed formally through the two appeal committees. Okay, well, time's almost up, and I would just like to leave you with a final thought, and that is the tax landscape has evolved considerably over the past 5 years. It is now increasingly important for decision makers doing business in Saudi Arabia to ensure that there are stringent procedures in place to monitor and assess tax risk, and to eventually determine if such risk can be minimized or even removed. My thanks to Shiv, Dinesh, and Adil for their contribution to this morning's webinar. I would also like to thank our business development team of Tom and Fatima for the help in making today's event a success. We look forward to you all joining in on the next monthly Tax Matters webinar, which will be on December 14th. Details and registration will be circulated in our weekly tax flash, which goes out on Thursdays. If you are new to the tax flash or to the Tax Matters webinar, please ping me and we'll send you the registration link. Just one final point, we will of course share today's slides in the next day or so. And apologies if we haven't got around to answer your question. we will do so. Please email us on tax@keypoint.com or happy to take a call. In the meantime, have a good day and stay safe.